Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior Podcast. Our goal with this podcast is to sit down with top market practitioners, learn about their background, some of their experiences through the financial industry, information about their process, their routines, how they do what they do, and how they assess market conditions, and finally, what those tools and techniques are telling them about the market conditions today. Great interview to share with you here recently with Mike Dickson. Mike is the head of Research and Quantitative Strategies at Horizon Investments. This conversation hits on a deep dive of sorts into our benchmarks, how Mike and his team create factor-based models to try to beat those benchmarks. We talk about the over-concentration in the S&P 500, the NASDAQ 100, other indexes, why the path matters when you're analyzing trends and momentum. So please enjoy this interview with Mike Dickson of Horizon Investments. Super excited to be sitting down today with Mike Dickson. Mike's the head of Research and Quantitative Strategies at Horizon Investments. Mike, I've heard of you and followed your work, and I'm super excited to be able to ask some questions on behalf of our audience. Thanks so much for coming on the show today.
Yeah, absolutely. Thanks for having me. Excited to have this conversation.
So I love when it's a new face, new voice for our audience to get a little bit of background on your investing journey, because for a lot of our viewers, that's sort of where their focus is, upgrading their decision making and their process. You are, really have more of a quantitative focus, but you've had a very interesting evolution in your career from an academic background to an investing background, which is a transition I would say very few are able to make successfully. It seems like you've pulled it off. Can you talk a little bit about your academic background and kind of what that transition has been like for you?
Yeah, sure. I've been here at Horizon Investments for going on my 11th year, and you're right, came from the academic side shortly out of some PhD studies at the University of North Carolina here in Charlotte, where we're located. And look, when I was doing a lot of research there, I did some deep dives and a lot of personal research on kind of factor investing. So I'm sure many of the viewers would be familiar with Fama French and the associated smart beta styles that were quite popular for as far as ETFs. So launches and stuff were concerned around that kind of early 2010s timeframe, and also did a good bit of work on the derivatives market. But again, much of that was, academic focused. And, a lot of what that research involves is a lot of data wrangling, developing rules, kind of systematic implementation, and then, taking that set of rules, putting it to some data and looking at, historical trends. But look, when you come into, actually putting, money to work in real time, I think one of the biggest lessons that I learned is, just this difference between economic significance and statistical significance. And, in the academic space, it's all about stats, right? You want these large T stats that show, over this 30-year time horizon, look at your Sharpe ratios and how great they were. And then when you're actually putting, client money to work, we're trying to navigate COVID and Trump tweets and, changing policy, and you figure out that, hey, this isn't the law of physics. Like, these rules change, and they can change regime shift on a dime.
Right.
And so that's definitely been something, that you got to get punched in the face a few times to really get your sea legs under you. But it's been a fun transition.
Mike, I'm surprised that a president's aggressive use of social media wasn't in the models you were researching back in the day, right? I mean, the number of things we're trying to get our head around is pretty fascinating. So, having studied factor investing, right, and for those that are unfamiliar, right, factor investing, this idea that stocks and the performance can be described by different factors, right, like valuations or quality or volatility and some of these sorts of things. I know from time at Fidelity, there would often be what appeared to be a really great model, but then you would go to put it into play and it would not do particularly well, because the transition from it looked good on paper in Excel or in a model to actually generate, to making money was a tough transition. When you're analyzing factors, when you're evaluating a model, how do you make sure that it transitions well into this is actually going to work in real life when you put money behind it?
Well, I mean, that really is the secret sauce of research and bringing that into, a successful strategy or fund.
Yeah.
But look, I think, one of the core competencies of, quantitative research overall is proper back testing. And with that,
Mm.
that means clean data. It means a know-how and a set of rules without look-ahead bias and other, imperfections in your analysis that may not translate well to the real world. But then also, it's also studying a lot of different regimes, right? You
Mm.
can look at data over a particular point in time, and maybe it was, for example, in the 2010s, you have this, very kind of low rate regime of like no inflation and the Fed keeping interest rates relatively suppressed. And then look what happened post COVID. We have this just massive regime shift
Yeah.
where now we have, inflation was a problem. Rates went from 0 to 5%. And you have this entire new set of kind of macroeconomic forces that were not present in the prior 15 years of data that you might have back tested, right? And so you have to be aware of these types of biases when looking and bringing a strategy, to market. Now, the historical backtesting analysis is crucial to understand how markets are going to behave, but you have to also understand what other forces were going on in the macro environment when that was happening. And, through that, research process and kind of shocking some of your assumptions, perhaps you can, tweak certain styles, use other types of characteristics and screening variables, or even how you're going to weight stocks in your ultimate portfolio to account for kind of a different macro environment, and really
Mm.
with the goal of holding on to some of the purity of what that, certain stock characteristic or group of characteristics is going to provide, but at the same time, still be able to, be resilient to the macro environment that you're in today.
Mike, I'm getting the sense you're a true professional in the way that you just answered that question, right? Just thinking about the context, thinking about the different regimes as you described, I feel that the power that individuals have to backtest probably better now than ever before, but the opportunity to make completely horrible assumptions about what it makes a good backtest and missing some of those regime things, right? You have a perfect system or an approach that works very well, and I remember asking someone, years ago, like about the back test, and it turns out they had like analyzed like a 12-month period in a very specific market regime. And I'm like, you are making a monster assumption that tomorrow is going to look anything like that period you just tested. I think there's a lot of wisdom in what you just described there, Mike. Can you talk about? I mean, now that again, now that you said you've been in at Horizon for about 11 years, can you talk about some of those formative years as you're just getting started? Was there a challenge, a lesson learned, a miss that you look back now and said, wow, that was a huge learning opportunity earlier in my career? I feel like most successful investors seem to have that early miss they can look back to. What's that for you?
Oh, absolutely. I mean, very clear to me. One of the one of the biggest things in strategy design, when you're thinking about, at least in my seat, which
Mhm.
is a little bit more benchmark focused. One of the big
Yes.
concepts that we focus on is tracking error, right? And
Mm.
tracking error, just for the general audience, right, is going to be variance of your returns around some benchmark. So if I'm trying to beat the S&P and I invest in a bunch of smaller cap securities that don't look anything like the Mag 7, I'm going to have a significant amount of tracking error. In other words, my returns are going to be a good bit different on average than what the S&P realizes. And you can even take this, even if you're benchmark agnostic and you're just, investing without a benchmark in mind. One of the things that in both those cases can happen is you can have a path that is very, very poor, something that might have back tested well, great average returns, but the path was something that is extremely difficult to stay invested in.
Right.
This is particularly true and a lot of factor and style exposures that are, benchmark aware, but it can also be true for an individual when they're trying to put a portfolio together and maybe they're not aware of their own risk tolerance, right? And maybe they get a little bit over their skis and you leg into some very aggressive positions. Volatility can persist in the opposite direction that you want for a long time. And that can be extremely problematic, both in a benchmark aware case or a benchmark agnostic case, because one of the things I saw early on is it can be very difficult to stay invested in a strategy if you don't have the proper set of expectations for both yourself and the end investors very much front and center. And so you got to be aware that it's not the averages that matter. It's the path to get there is just so acutely important. And
Yeah.
I think that really plays a huge role in strategy design, whether it be risk management, constraints, having, stop losses and things of that nature in order, just absolutely critical to make sure that when things get rocky, that you can actually stick to the plan because it can be very difficult to do so in real time.
I know we were speaking, Mike, before we got started about my background in technical analysis, and I know for a fact momentum-based strategies often can have fantastic returns but aggressive drawdowns, and
Mhm.
that end result sounds really good until you're walking that path, and those big drawdowns. Not everyone can sort of be part of that trip, that entire journey. That's something you have to very much think about. I
Yep.
appreciate you saying that. Um, Tell me a little bit about the benchmark. You mentioned you analyzing benchmarks, thinking about tracking error. In my experience working with institutional investors, we would often lament about the S&P 500 being a very difficult benchmark to beat, just a challenge. And I
Mhm.
can't imagine that's gotten any easier in 2025 or in recent years. Can you talk a little bit about the structure of the S&P 500 when you're evaluating that benchmark in 2025? Would you agree that at this point in 2025 it's been a difficult benchmark to beat, if that's your goal, and why or why not?
Well, look, the S&P 500 represents basically the best in class of stocks, really
Yeah,
in the world, and dominated, of course, by the U.S. economy. But these U.S. companies are obviously have huge global presence as well. But look, one of the things that's unique about the S&P 500 that you don't quite find in other and a lot of other benchmarks and indices is the fact that there's no real cap in place. So if you are a smaller mid cap stock or, some style expression, growth or value, at some point you are going to kind of grow yourself out of that particular index and you just graduate to the next higher, a small cap to a mid cap or a mid to a large,
sure.
or whether it used to be a value stock, but then your price has appreciated so much, you get rebalanced out of that basket. And with that type of those type of dynamic benchmarks, you have a somewhat of an anchor in place because they're always going to represent, and there's going to be a rebalancing mechanism that's going to kind of bring them back to par over time. In the S&P 500, and this has been just so much acutely true in my experience and investing life over the last 11 years. I still remember having conversations with colleagues here in the office back in 2019. You're looking at the top 10 in the S&P 500, and we're like, man, I cannot believe this. The top 10 are now 20% of the S&P 500. The concentration is just
That's so
absolutely
quaint, right?
absurd, right? And then look at us now. The Mag 7 is 35%. And look, I do imagine most of the folks viewing your show, aware of these concentration levels, but perhaps others that do not respect it as much as I would in the seat of trying to beat this. You have to be very cognizant and aware of these kind of the market cap tilts that are present. The concentration levels have gotten enormous, and it does make the S&P 500 more difficult to beat. But I can assure you, it is very possible. You just have to be quite clever about it. But by not respecting that market cap and the fact that the S&P itself is weighted, giving larger weights to the bigger companies, you
Yeah.
can end up in that situation I was referencing earlier, where you might have a nice average back-tested factor exposure that did great over a 25-year period. But over that 25-year period, you did not have a Mag 7 that was 35% of the index. You
Yeah.
had a Mag 7 that was growing into that over time.
Right.
And it's just all about that tracking error awareness. You got to be cognizant of that. You have to respect the market cap, and account for that very acutely when putting together strategy design. It's possible to beat, but it is hard. And I do think I do think that with some clever rules and risk controls, you can gain out some edge over time. But it's probably harder today than it was when I first started.
No, 100% agreed. And I remember not too long ago, the level of concentration felt extreme. And now I realize we were just getting started, right? We weren't even getting to the levels that we're seeing now
Mhm.
in terms of the top heavy nature of this benchmark. So how does that evolution in the benchmark affect how you are trying to construct a model or outperform today. And I would say specifically, if you're a money manager trying to beat the S&P 500, there's a severe career risk in not owning Meta, Alphabet, Microsoft kind of names that are a huge weight in the benchmark. If you don't own those, your chances of outperforming are probably very low, or certainly it's a much more bigger challenge. How does that, the extended nature of the bull market that we've seen now into the end of October, does that affect how you're analyzing things or how you be positioned today? How do you manage that, top heavy nature, that risk with those biggest names that have obviously done very, very well? At some point, I'm told they can also go down. So how do you manage that transition and that risk?
Yeah, that is definitely the case. They can go down. We haven't really seen it much, but I also hear that's possible. Look, I mean, of course, we manage and oversee many strategies, but for the strategy specifically, like in that large cap space, I think it's about capital efficiency, and I think of that in a couple different ways. So, one way, for example, when I look at the market now and it being benchmark aware, you can't afford to be underweight the top of the market. A lot of those, AI hyperscalers, and the Mag 7 as an example this year has seen quite a bit of bifurcation. I mean, you have your Microsoft, Google, Meta, NVIDIA's at the top that have done very, very well. By comparison, though, Amazon, Apple, Tesla, are barely even up on the year. So you had bifurcation there. And then, of course, you have these new entrants, whether it be Broadcom or Oracle, that because of the AI theme are really starting to pop up. But if I'm building a portfolio and let's say, for example, I'm bullish on the small mid-cap trade, but let's say that I sell just broad large caps in order to make room for small mid caps. Well, the problem with that is if I just do that particular trade, I'm now underweight the top of the market, right? Because it has to add up to 100%. Yeah. So what can you do about that? Well, there's a couple ways. One, you can be much more selective and concentrated in that top of the market beta that you're going after. So, for example, there are quite a few, a lot of active type strategies out there that can give you very concentrated, top of the market AI related exposures. And when you look at what's driving the market, for example, this year, it is that top of the market beta that is driving the market. So one way to think about implementation there is let me get kind of more of that mega cap growth beta that I want with a smaller weight, which can allow me then to make room for something else like a smaller mid cap, more opportunistic kind of reversionary play on the other side. And I might be underweight kind of basically the middle size large caps, but I'll still be market weight or overweight the top of the market and kind of get this little barbell type of approach, if that makes sense. That's one way to go about it. Another way that, that we do a lot of work on here as well is through the use of derivatives. Derivative markets are extremely mature. There's been so many amazing developments over the last 5 years, whether it be just for, a lot of the most liquid markets having options mature weekly, then now pretty much every single day for a lot of the most liquid markets. So you have a lot of maturity options. When you look at, in a lot of stuff that we do in mutual funds and ETFs, you have, additional type of optionality in there for the use of things like flex options, which are exchange traded options, but allow you to customize terms. And again, going back to, putting a portfolio together with capital efficiency, derivatives can be an excellent way to allow you to do that in a real risk managed way. And we're very big users of that, here at Horizon, and really kind of lean into that, which can allow you to get very concentrated exposure, again, in a capital efficient way to an area of the market that you really, really like. But it doesn't necessarily mean that you have to, carry less overall weight in order to do so because of the capital efficiency, through the use of derivative and options instruments. But those are two very capital efficient ways that we go about thinking that basically, using more concentrated selective exposure on a security selection side, and also derivatives is a great way to gain an edge and get exposure to additional risk premia out there that may not have been available, 10, 15 years ago.
It's so interesting. You mentioned a couple of times just about and earlier in the example, I remember years ago, probably early 2000 teens or so, and I remember coaching a portfolio manager on how they're positioned. And I remember telling him, look, they were talking about the biggest bets they were making. And I said, actually, the biggest bet you're making is not owning Apple and Microsoft right now. Like that is the first decision you're making. So let's make sure we're comfortable with that. You use that phrase capital efficiency a number of times, Mike. For those that aren't familiar with what you're referring to, give me the quick summary. What does that actually mean? What does that how does that inform a decision you're making in a portfolio?
Sure. I mean, so I guess the two examples I gave, one, the first one probably a little bit easier to grasp is on the selection side. So let's say I believe, which I do believe, that if the S&P goes higher through the year end, that is going to be led by the top 10 in the market, right? That's going to be led by basically like the Mag 7 and its adjacent peers getting ready to become the Mag 7 or those top 10 mega cap companies. And so if that's where the large cap beta is, then one way to be capital efficient would be just to overweight that top of the market. And you, by doing so, you're getting basically more exposure to the beta that's driving the market higher, but you have to give up something for that. And so, for example, what you might be giving up is a lot of weight in, let's say, the 50 largest stock to the 400th largest stock, right? So you might be getting underweight kind of the middle part of the large cap market, but you maintain that exposure to the what's really driving the beta. And that's that kind of, AI trade. That's one way to be capital efficient.
Got it.
On the derivative side, though, it's the idea that, derivative is a leveraged instrument, right? So if I want 1-for-1 exposure to a certain market, whether it be S&P, NASDAQ, the Mag 7 alike, I do not have to spend $1 to get $1 worth of exposure. And that, that comes through the use of derivative contracts. The one thing that makes derivatives a little more complex is you don't just have to be right about the direction. You also have to be right about the timing in a lot of cases, right? But it's capital efficient in the sense that I can get $1 of exposure without spending $1. And in a similar vein as kind of just being more concentrated in like the top of the market, if you believe that's where the beta is, it can allow you to basically get a 1-for-1 or even more than 1-for-1 exposure with less than $1, at risk. And that allows you to diversify with the rest of it elsewhere in your portfolio where you see opportunities.
That makes a ton of sense. Thanks for explaining that, Mike. So there have been a number of structural changes in the market since you and I have been doing this. And just since you've been involved at Horizon, one of the biggest changes I would say has been the concentration of individual investors playing broad market ETFs, right? The SPY, the Q, and also leveraged ETFs and things like that, to a level that certainly we didn't see when you're just getting started.
Mm-hmm.
Has that had an impact on factors, on models, on how conditions have changed? Because if I told you when you got started, hey, look, over your career, there's going to be a huge influx of people that aren't picking individual stocks, they're just buying a big ETF, and that probably has some structural risk of some sort. Has that impacted what you do at all, or has that been a non-issue, do you say?
Yeah, I think it does impact a lot of things. Primarily when you have a lot of these, leverage products in place, when you have, let's say retail investors in general kind of flocking to some of these products, there's a dealer on the other side, there's a market maker on the other side making liquidity for these markets. And it can cause, just because, a retail trader or the group of retail traders themselves may not be moving, huge amounts of capital, it can cause the market makers on the other side of the trade to do so. And you can get some very quick, very fast moves in individual indices or, underlying, stocks. I think one of the ways to that's kind of affected things is just to understand that you can have these kind of sharp reactions that are kind of not permanent, if that makes sense. In a lot of cases, it's a lot of moves that you can see around, end of days, end of weeks, end of months, rebalancing effects and things of that nature. These can be, temporary moves that are basically not full of very useful investment information and are more a result of basically market makers repositioning their books, and they, in a lot of cases can reverse positions quite quickly. I think it introduces a little bit more day-to-day noise than maybe was present 10 years ago, as a result of having a lot of these kind of leverage positions. And so
Yeah.
I think that that's something to be aware of. And then just again, with everybody, I guess with passive type vehicles becoming more popular, over the last few years, again, it just kind of reinforces my comments earlier. You have to respect the market cap a little bit more in strategy design and implementation. But at the same time, that type of crowding per se creates opportunities, right? You do get, again, it can be quite difficult to tell exactly when things are going to turn, but it's just like filling up a 5-gallon bucket full of water. Like at some point that thing's going to tip. And when it does, things are going to move, and they can move violently and quickly. So, while it can introduce a little bit more noise, it can also introduce a significant amount of opportunity. But it definitely has changed things for sure.
Yeah, so it seems like separating the signal from the noise is a task you and I and many others will still be faced with for the foreseeable future.
Yeah,
I want to make sure we
always
talk about
figuring it out.
yes, right. I want to make sure we talk about the current market environment here, Mike. Obviously, the risk assets, particularly equities, have had an exceptionally strong run off of the April lows. I mean, if there's been one surprise for me, I mean, just the lack of any meaningful drawdown. We've had a couple brief kind of initial hints of some sort of corrective move, but all have dissipated and the market's returned higher. You mentioned being fairly constructive on equities between now and year end. What kind of fuels that sustained optimism? And I guess the other side would be, what's the biggest risk, the tail risk that could actually cause this great bull market of 2025 to be ended?
Yeah, I think one of the things that is really a key factor for me this year when you look at market returns, I think a lot of folks, just given where valuations level, may be inclined to think, oh, wow, we've had valuations really increase a lot this year. And that's why the return of the market, S&P or NASDAQ, is up so much. And that's actually not the case. When you look at valuations, I think one of my favorite kind of valuation measures to look at is going to be looking at forward earnings, like what's kind of expected in market prices as opposed to trailing earnings. And when you look at, kind of forward-looking PE ratios for S&P, S&P 600, NASDAQ, Magnificent Seven, you might be surprised to learn, especially even with the very, very top of the market in the Mag 7, PEs year to date are actually down. So on a PE percent change on a forward-looking basis, year to date, you're basically flat to down in a lot of the top of the key markets.
Wow.
And so, what else is driving the returns? Well, it has to be the E part of the PE, right? And that's exactly what we've seen. You've seen earnings growth expectations, grow substantially over the course of the year. So when we look at, S&P, you've had, expected 12-month earnings growth increase roughly 15% on the year. For NASDAQ, that's going to be closer 22, 24%. In small mid caps, that's still a relatively modest 6, 7, 8% range. But you also haven't seen, in a lot of cases, analysts upgrade their estimates either for that small mid cap space, which is an interesting opportunity. So this year has been fully supported by fundamentals, is kind of the summary of all of those numbers I just threw out. And so that means we are not sitting here in the tech bubble of the late 90s, right? This companies today driving this innovation, driving this change, have enormous amounts of cash flow. They are delivering on that. They are, investing obviously at a very aggressive rate. But for what we've seen this year, the market return has been very fully driven by underlying growth and expanding margins. And all of that is, I think, something that without looking at the data, you might not necessarily think. It's probably easier to think that it's been valuation driven, but it hasn't.
And certainly looking at the headlines, right, Mike? I mean, there's been so much coverage of markets are overvalued, markets are overextended. And I would agree. This is one of those times where if you look at the PE ratios and particularly the E part with a in the rearview mirror, you get one sense that these stocks are going incredibly high on maybe lower earnings, but the expectations is what fuels the optimism. I think that's a fair point. You had mentioned a couple of times, particularly SMID caps, the small and mid cap space. Is that a valuation play, or are there other reasons why you think small and mid caps, which honestly have been lagging for a little while, what causes them to start to improve, and certainly on a relative basis?
Yeah, we've had a lot of fits and starts with the
Yeah.
small cap trade, over the past several years. And I think one of the just macro forces overall, of course, that has really weighed on the sector broadly is going to be the level of rates, not
Mm,
necessarily the change in rates as much as the level of rates. I mean, the level of interest rates, obviously post 22, has been substantially higher than it was, and these small and mid cap companies do not have the balance sheets and cash flow of the mega cap S&P 500 names, and that's been a little bit more of a debt burden on them than it has. Nvidia is not borrowing much money, right? They've
I think
got
they're good, right?
Microsoft, they got plenty.
Yeah,
Right. So changes in interest rates may impact sentiment, but like it's not really impacting their business model that much.
yeah,
It's
yeah.
not the same for the small mid cap space. So I think small mid caps have multiple catalysts working for them, and most notably in the short term, kind of more of a tactical catalyst is going to be this level of interest rates. I mean, something that I was highlighting earlier this week for and some internal notes here is the MOVE index, which
Hmm,
is the cousin to the more popular VIX index. The MOVE
yeah,
index measures implied volatility for interest rates, not the S&P 500 like the VIX index. And we recently, just this week, it's sitting at a 4-year low. And
yeah.
this is as we're heading into a Fed meeting tomorrow, where it's fully expected and priced in that we're going to get a single cut here in October. And it's also effectively fully priced in that we're going to get one in December. And futures pricing for Fed funds rates, has us kind of ending at that terminal rate of around 3%, roughly 12 months from now.
Yeah.
Um, and as a result, as we get closer and closer to this happening, you're seeing this interest rate volatility come down a good bit. And that's it. That's very constructive for small mid caps. Most importantly, I'll note that the right tail scenario where interest rates are going to be going up because of massive inflation concerns, that's effectively off the table now, right? So lower rates overall is going to be very conducive in the short term for small mid caps. I also think you mentioned valuations. Yeah, I think that's a huge part of it as well. You've seen earnings breadth, expand materially in that smaller mid cap space. Earnings surprises the last couple of quarters have been, in the double digits for small cap stocks, kind of beating analyst estimates, and valuations have not increased there. So you have
Mhm.
an environment heading into earnings season here where valuations are the same or lower than they were. Analysts have not been increasing expectations yet. You've seen improving margins, and you've seen kind of a steadier climb and growth in earnings beats. That presents a pretty low bar, I think, as we head to earnings season. And then, final third point I'll make just on kind of a longer term catalyst, just the current administration and some of the kind of regulatory backdrop, whether that be M&A related or just domestic focused, kind of America first type policies. A lot of these small and mid cap names, they do not have the international footprints that the large cap universe does.
Sure.
And so they're quite insulated to the domestic economy. And so on a more kind of longer term catalyst there, I think makes for a great entry point, considering small mid cap stocks have not ripped like the top of the market has. So you have, I think, a number of reasons why that can be an interesting place. But, make no mistake, I do want to be, think about this in a capital efficient manner when
Hmm.
you're putting a portfolio together, because I also think it's a little dangerous to be void of big allocations to a lot of those AI hyperscalers. So we got to be
Right.
careful about how we put that together, but there's certainly ways to do that.
Mike, exceptional bonus points right there for dropping the move index. That's not one that comes up very often, sort of like the VIX and the bond markets. Well done. And 100% agreed, right? Both of those, and the VIX has come down now below 16 this week. So both of those volatility measures coming in quite a bit. One final question. The last area I wanted to ask you about is gold, silver. Precious metals have had an incredible run, but choppy, October here, certainly in the last week. Gold pushed above $4,000 an ounce, started to pull back a little bit. Are you more confident? Gold, for most institutional investors, kind of an out of benchmark bet to be taking a big gold position, but gold's been working. Is there anything that gives you confidence or skepticism on the trend we've seen and this corrective move we've seen more recently in gold?
Yeah, gold has been just on an absolute tear. I think we wrote about this just last week, I believe, for some clients. I mean, since the end of 2023, you're up about 100%. Okay, so
Wow.
you're what is that? 22, 21 months.
Not
Gold has
bad.
doubled in price. Well, I'll tell you one of the things that gives me a little bit of a pause, right? Is first of all, I mean, gold is an asset class all in and of itself, right? It doesn't have cash flows, doesn't have default risk. It's, of course, thought to be, a stable source of value. It tends to trade on uh, level of real interest rates and changes in real interest rates, except this time, which is one of the things that gives me a little bit of a pause. It also, tends to trade on, concerns, which I think is driving a lot of this a little bit lately, deficits,
Yeah.
geopolitical risk, that sort of thing, and investor sentiment as well, right? That's going to be a very large driver of gold. And I know, given your background and probably a lot of your viewers on the technical side of things, I think technical markets are important to keep an eye on when you're looking at gold and investing in gold, primarily because with a lack of cash flow and default risk to kind of gauge how attractive it is, investor sentiment is going to be a huge part of that, and technicals are
Mm,
going to be an excellent way to get a read on that. Look, I do think, I mean, gold has done an enormous job from a diversification perspective. Lately, it has definitely performed very well during equity market weakness. Obviously, also the returns themselves are quite strong. But what I think a lot of investors don't realize as well is gold in general is as risky as equities as it relates to traditional statistics.
yeah.
Whether it be volatility, gold's got about the same level of volatility over the last 20 years as S&P 500. Drawdowns, looking back from 2011 through 2015 with the taper tantrum stuck there in the middle, gold drew down. It basically got halved, right? It was down about
Mm,
45%. S&P was up about 90 over that period of time.
yeah. Yeah.
So, diversification can go both ways. I think, I think when thinking about it in a portfolio, you do have to think about it from a risk budget perspective, and at least understand that volatility is possible.
Yeah.
And also, I think you do got to be aware a little bit of some of the technicals, and things have been very extended there. And I think the little bit of the weakness we've seen lately is, again, it's just a little bit of a weakness. Let's face it, it's still up 45% year to date. It's doing just fine. But when you do have these kind of extensions, quick pullbacks are certainly possible. So I
Sure.
think a little bit of historical context is also very helpful before deciding to, sell your equity or fixed income positions and just go straight all in for gold.
It was an awesome history lesson, Mike. And I have often found when people actually look at the data on gold, they're surprised by the performance in different cycles, particularly the relationship between gold and risk assets like equities. Surprised by the volatility, which is
Mhm.
way different than what many would expect. And by the way, the quote was, "Technicals can be an excellent way to get a read on that." That was a Mike Dickson quote. Thanks for offering that up. I did not see that quote. You offered that up all on your own.
Yeah.
Mike, this has been a real pleasure. I can't thank you enough for coming on the show. Great to meet you. Great to learn a little bit more about your background and your process, and great insights on the markets. I hope we can continue this conversation down the road. But for today, I'll say thanks so much for joining us.
Yeah. Thank you very much. Appreciate you having me on.
That was a fun conversation. Took me back to Fidelity days in a lot of ways. We would spend a ton of time thinking about our benchmarks. With institutional investors, your evaluation, your performance is all measured based on how you do, how your portfolio does, how your shareholders do versus some benchmark. And so if it was the S&P 500 or the Russell 2000 Growth Index or the Russell 1000 Value Index, the construction of that index was vital because you needed to understand where your returns were coming from. So a whole set of tools and techniques that institutional investors use, what I would describe as portfolio attribution. When you're analyzing the performance of a fund or of a portfolio over time, you'd run an attribution analysis. And an attribution report would basically show you where the returns had come from. How much of your performance came from just the fact that the markets were up, what we call market beta? How much of that performance was based on your tracking error, based on your active share, based on those bets that you were making that were different than your benchmark? How was your bet sizing, right? How much you were allocating to each idea? What about the volatility, the earnings, the size of the companies, right? You could get to very granular measures of performance and really try to understand, am I doing a good job just being invested when the market is strong and not when the market is weak? Is it because I make good sector bets, good industry bets? Am I a better trader or a better long-term investor? Is it more about stock selection or individual security selection? So my conversation with Mike really touched on a lot of those concepts. And I hope what you got out of it is how, as an individual investor, as a financial advisor, you can leverage some of those techniques that institutional investors sort of take for granted, right? You have those capabilities to measure with a lot of investing platforms in 2025. You have the ability to understand more about your returns now than ever before. But I thought his comments about bet sizing, about the path, right? How the trend is important, but the path that the market takes is so important. And using technical analysis, his quote, which I love, technicals can be an excellent way to get a read on that, right? To be able to get a read on the path and make sure that you are following the right measures of momentum. Really appreciated his discussion about the benchmark, the overconcentration, the top-heavy nature, why that means you have to own some of those names to do well, but also recognize that opportunities can certainly be there outside of the Magnificent Seven. And I appreciate Mike sharing some of the ways that he thinks about that. Great word of caution there about backtesting. I often find that individual investors, when they learn about backtesting, they turn kind of backtesting happy, right? They just sort of feel like once they backtest something, that just means it's gonna work. What you have to remember is that a successful backtest in most cases tells you what has worked. There's absolutely no guarantee that what worked yesterday is what's going to work tomorrow. And that's why I pressed Mike a bit about backtesting, and he shared some of the methodology that they use. There's a lot of steps you do, things like walk forward analysis and others, which we don't have time to get into, that help you really check and make sure that you're not curve fitting, that you're not just over optimizing for some historical regime, but that you're really trying to construct a portfolio or a strategy that is based on what is most likely to work. And then make sure you use good money management techniques in case those techniques don't work well. Really loved Mike's take on the current market environment, loved about precious metals, about interest rates, about the overall market evolution here in the fourth quarter of 2025. So thanks again to Mike Dickson of Horizon Investments joining us today on the show. By the way, we're always looking for great guests like Mike to come on the show. Mike commented when we were off camera that anyone like Mike that does a lot of media hits, you're used to sharing about 2 to 3 minutes of information. It goes by very quickly and then it's over. And he said he loved the fact that we're able to actually take a deep breath and just talk for a while. And I'd love to have that opportunity with other market experts. Anyone that you see on TV, that you see another podcast, you think, wow, that would be a great guest on Market Misbehavior, let me know. Drop a comment anywhere where you're seeing or hearing the interview. Let me know who else we should approach to be a guest on the Market Misbehavior Podcast. By the way, if you want to learn more about the tools and techniques that Mike and I sort of alluded to, things that will help you understand the path of the markets, measure price momentum, and define the trend, and then recognize when the trend has shifted, if that's of interest, our Market Misbehavior premium memberships may be a great opportunity for you to upgrade your own decision-making. 3 great benefits: courses, commentary, and community. Courses, you have access to all of our virtual courses, including Flight School Behavioral Investing, where I'll teach you all about behavioral finance and all about technical analysis. Commentary every week. I have our weekly flight plan where I share with you our main investment report. We look back at the week that just happened. What did we learn? What was new? What was different? We look forward at the week to come. What levels, patterns, and signals are we looking for? Also, our monthly chart review, where we apply some of our proprietary market indicators to a series of ETFs and asset classes. Finally, community. You'll have full and immediate access to our member community where you can ask questions. You can learn from other like-minded investors. I'm in there every day, checking in, answering questions, sharing charts, and sharing ideas. We would love to have you join us as a premium member. Go to marketmisbehavior.com/premium for more information. And don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. I'm Dave Keller with Market Misbehavior. Thanks for joining me on the show today. And remember, it's always a good time to own good charts.